Hi everyone, thanks for coming back. Juan Finance here, and in this video we're going to cover systematic and unsystematic risks. So first, let's have the definition. Systematic risk refers to the risk inherent to the entire market. It's also known as market risk, and the risk is commonly caused by economic factors, geopolitical concerns, and other financial regulations. Now, examples are number one, we have pandemic, we have trade war, unstable currencies, we have monetary policy rate cut, we have corporate income tax. Now, in the case of the Philippines, for example, if you have considered only two stocks, let's say International Container Terminal or ticker ICT, and we also have Bank of the Philippine Islands, ticker BPI. Let's say you only have these two stocks in your equity portfolio. Now, what happened is that ICT would suffer from pandemic, trade war, because they have very controlled volume. Also for the unstable currencies, because that would affect the import and export level. Now, if you're going to look at the financial industry, banks would suffer also from the pandemic because our central bank, Bangko Sentral ng Pilipinas, would need to cut interest rate, and we all know that when rates are very low, that would adversely affect the income of the banks and other financial institutions as well. And we also have this corporate income tax hike that may drag their bottom line. So these are just examples of the different equity risk and their impact to specific stocks in a specific industry or a specific sector. So that would trigger your portfolio to go down, suffer from capital losses because both of the stocks were massively affected by these factors. So how can we reduce systematic risks? Now, the answer is through diversification. Now, make sure that your portfolio is composed of various assets. So the only way to reduce systematic risks is to diversify across assets. So let's say your portfolio, you already have your stock for ICT and BPI. Let's say you have 91-day treasury bill. So it's a money market asset class. You also have your bond from, let's say, from San Miguel. And you also have the Ayala REIT, the first REIT in the Philippines, and you also have the ETF, which actually tracks the PSEI, or the top 30 companies of the Philippine Stock Exchange. Now, with this diversification across various assets, it can benefit from the interaction of this one or the interplay of yields. For example, this four assets here would give you an upside while you still have your ICT and BPI on a downside. Then that combination of return can give your portfolio, an unrealized gains instead of having a loss of, let's say, just focusing your portfolio into ICT and BPI. Now, how about unsystematic risks? It's actually a specific risk to a company or industry, and it's also known as residual risks. The risk is commonly caused by a company engagement or, let's say, industry regulation. So this time, it's actually a risk that is very specific to the company. So examples are, let's say, company risk, you have fraud, high bad debts level, or you also have failed business segment. Now, if let's say you have your portfolio like this, and then if you're going to look at here, we have BDO, Metrobank, and BPI. These three actually belong to the same industry. We call it financial, and the same sector. We call it banking. So if you have here, let's say, fraud in one bank, we have high budgets level and failed business segment, for example, or if the financial industry is suffering from, let's say, low interest rate or high reserve requirement ratio, stringent bank regulations, that would directly impact these three stocks here. Now, because you did not apply, a well diversified portfolio across asset classes, this may perhaps suffered in what we call unsystematic risk. So these three component risks may be applicable to each of them or one of them, as well as these industry risks here. So that would trigger your portfolio to have a negative yield. So how can we reduce unsystematic risk? Now the answer is diversification. So you have to diversify across industries, across sectors. Now, for example, other than your ICT and BPI, you also have your San Miguel and Ayala land. Now, if you're going to look at here, ICT belongs to the industrial um, um, sector. We also have San Miguel consumer, Ayala in properties, and your BPI in financial. So that combination of stocks in different industries in different sectors can help your portfolio to buffer potential losses. So the combination of yield may give your portfolio an upside instead. Now here is an example of portfolio and application of diversification. Now, if you're going to look at here, our portfolio is composed of various assets. We have a mutual fund that focuses on money market or short-term investments. We also have our dollar bond fund. So if you're going to consider the previous discussions in our review of strategy, we did convert some of our peso into dollar because peso nowadays is very strong because of the pandemic and other factors. So it's an opportunity for investing in dollar. We also have allotted a portion of our portfolio to a REIT, which is the first REIT in the Philippines, which can give you a consistent cash flow of about 5% dividend every year. So that's other than the price appreciation. And looking at the equity side or stocks, we have peso and we also have our dollar stocks. Now, if you're going to look at the Philippine stocks here, they're actually spread all throughout various industries in various sectors. We eliminate what we call the unsystematic risks. So here we have the banking, Security Bank. We have here Shell Philippines, which is in oil. We have tech in semiconductor. We have here PHR, um, Holcim for properties. We have MAC for servicing, Dito for telecommunications, AREIT, we have RCI, Megawatt, and so on and so forth. Now, for our dollar stocks, it's spread across various markets. Now, if you're going to look at here, Yadea is actually in Asia Pacific, in particular Hong Kong. We also have some stocks here in the European region. We have BP Oil, Orsted. We also have the ING, and the rest are actually spread or allocated in the US mainland. So this is an example of a diversified portfolio in multi-asset and multi-currency to address both systematic and unsystematic risk. Now the allocation would depend on your risk tolerance or your let's say capacity to absorb volatility of the market. So diversification is key. Characteristics of a well-diversified portfolio is that number one, it should be multi-industry and across sectors. And number two is that it should be multi-asset across currencies. And the core advantages is that it minimizes risks and optimizes the returns of your portfolio. So that's all for this video. Thank you very much for watching, and I hope that you learned something. Please do like the video, and if you want others to understand, kindly share this video. And if you need to know more, kindly subscribe so you won't miss any future videos that we're going to make. Thanks for dropping by.